Welcome everybody to this webinar. I'm very happy to present the off-grid solar investment trends of 2023. Share this, and I hope that this will be exciting insights for everybody. My name is Laura Fortes. I'm manage the Access to Finance program at GOGLA, and I'll be presenting these trends today with fantastic speakers that have joined me. If we can move to the next slide, you'll see them. So we have Diana Mbogo from Millennium Engineers, Jeff Mandy from BII, Taisai Murariwa from Natford Energy, Michael Franz from GET.invest, and Ravindra Dolare from Ecosen Energy. They're turning on their cameras, hopefully. The idea today is not for just me to be presenting data, but for them to be sharing their experience on each of the highlights that we have seen in the data from their very diverse perspectives, from investors to companies on the seed stage, productive use, more startups, and TA providers. So thanks so much for helping me do that. And I hope everybody enjoys it and this format. In the next slide, we start with the headline data. So this we put out already a few of the headlines. So we have seen 425 million in investments that have gone to 84 different companies. And those investments came from 49 lead investors. Perhaps to clarify, we have more investors in the sector in the database, but we are not tracking those that are either in syndicates or minority investors. And in the next slide, so perhaps a little bit of a reflection. It's been a difficult year. So we have seen in very key markets that inflation rates have been triple digit, sometimes second digit, a lot of times. So that has not made it easy for companies receiving their payments in local currency, being borrowing in hard currencies. But we've also seen very macroeconomic shocks, persistent climate threats, and apart from the inflation, the devaluation of very key currencies. If you go to the next slide, here we're going to see the historical trends. So we do see a big drop in 2023. It's partly driven by very difficult macroeconomic conditions. The contraction is of 43%, so it's quite important. If you follow the industry closely, you will know that Sunking last year raised a big equity deal, and that was a little bit of an anomaly. So an anomalous year. However, that doesn't mean that we do need a lot of those anomalous years in order to get to achieve our goals as an industry. And that growth needs to be sustained. So it's still something to be concerned about. Still, even then, with the contraction, with VC capital being scarce and equity numbers going down globally, this 128 million in terms of equity was surprising to a few of the stakeholders to whom we have presented the data. In the next slide, you'll see that the classification that we use for the sector in terms of companies. So we see that the behavior is very different depending on where you're at in the scale. It's actually a very objective way to classify it. So if you've raised more than 100 million in the database, in our database, you are classified as scale-up. If you have raised between 3 and 100 million, you're classified as startup. And if you raise between 0 and 3, you're classified as seed. So it's, more companies can move up this ladder as well. So we see that 58 companies were seed companies that raised financing, 20 startups, and 6 scale-ups in 2023. In the next slide, so this is just a way to show the data so that you see if we compare it in the same scale, you see the cumulatives and how they convert against each other. So perhaps, yeah, to observe that this year, for example, if we see the concentration on the top deals, startups are a little bit closer to scale up. So getting there. And if we go to the next slide, we will see specifically the investment trends from scale-ups. So in that upward bar, you see the number of companies that raise financing in this segment. This year we had 6 companies raising, and then here on the right, we put the companies that belong to this category in our database. And one clarification there is that we would only track deals that are related to energy access. So if a company or an investor reports funding to a deal that we have doubts that if it's really energy access, we would not track it in our database if the answer is no, it's not towards energy access. So this is because I mean, we've received the questions often. We see a few of these companies that are in the database diversifying. So just to clarify that we will only track those that are relevant. And then, yeah, observing 2023, the big equity drop is partly explained by the Sun King deal from last year. However, we also see a debt contraction. Something to look at, because in our sector, debt is used for consumer financing, inventory acquisition. So this debt contraction from the big players might have an impact in numbers. So we need to look at that closely and make sure that we're still delivering impacts. And a lot of the big players have the big numbers of impact on their shoulders. So something to look at. And an interesting highlight is actually on the next slide. So 75% of the debt that we have tracked this year going to scale-ups was off balance sheet financing. And that's something that we've seen is quite useful in order to do consumer financing and get liquidity on companies' balance sheets directly. However, it's only accessible to large players. We're having many talks and discussions around the potential for wider adoption, and we see this as a catalyzer for growth and innovation. I am going to invite Jeff Manley to reflect on this one. I know Jeff has quite a lot of experience in the sector as an investor, but also backing up one of the deals here. So Jeff, over to you for your reflections.
Thanks, Laura, and hi, everyone. Just a brief introduction. I'm Jeff Manley from British International Investment, BII, the UK DFI. I head our Energy Access and Efficiency team, and I'm also a member of the GOGLA Advisory Board. So have been involved in the off-grid solar home system space for quite a while. I think we've been talking about off-balance sheet structures for quite a while, and it's very interesting to see that this is now becoming a reality. Although I do think it's important to highlight that while this is a trend that we see in the financing, it is still very lumpy. And it's a very narrow trend in that I think, the vast majority of the volume of off-balance sheet financing has really been concentrated with a couple of the market leaders, most notably D-Light and Sun King. But maybe just taking a step back in terms of what is off-balance sheet financing, why is it interesting for the industry? And just very briefly, off-balance sheet financing typically means that rather than a company operating under the pay-go model, financing their receivables on balance sheet with a mix of debt and equity, and then recovering those cash flows over time as their customers make payments. In an off-balance sheet structure, the receivables are sold upfront, and this allows the company to improve its cash flow profile, to get more of the cash up front, to delever their balance sheet and can really contribute to a stronger financial position when it's done properly. So we participated in a transaction last year with Sun King. This was a $130 million transaction. I think two of the things that were really encouraging for us about this transaction, one is that it was entirely in local currency, and two, it involved a number of commercial banks. So I think these are two things that we've all been talking about for a long time, getting more local currency, getting more banks involved. And I think this was a really interesting proof point that this can be done under the right conditions. But as is noted on the slide, it is not for everyone, and it comes with some drawbacks. These structures are complicated, they're expensive and time-consuming to put in place. It requires a lot of capacity on the side of the company, and so it's typically not a viable solution for smaller companies. It requires large scale to be able to amortize those costs. So what we've seen is a number of stakeholders in the industry are starting to get together and talking about different models for multi-originator platforms that would purchase receivables and offer this type of financing to a much wider range of companies and then pool those together to mutualize the costs. So I think that's a really interesting trend. Lots of questions around that, but one to watch, and certainly one that I'm really interested to see how that develops over the coming years. Thanks, Laura.
Thank you so much, Jeff. And it's something also that we're definitely observing and working on. We have a receivables finance working group at GOGLA. So for GOGLA members that are interested, there's an option. If we move to the next slide, thanks, Jeff, for contributing to that. We're moving on now to the startup investment trend. So what we see here is an increase specifically for equity, and we will see in a bit where that equity is going. But yeah, the startups have raised 148 million. It's an increase of 60%. However, we see the number of companies that are on that phase raising being relatively quite stable. So around 20 companies, a little bit higher than that in the last 5 years have been raising. And in the next slide, we're going to zoom in the equity. We were surprised to see that equity had increased that much. And so when we went to analyze where it was going, we discovered that actually the pure space had benefited greatly. Actually, pretty big deals because there are two pure companies in this category. So perhaps not sort of like across the technology, but two companies have benefited from this, indicating that they might be experiencing growth and expansion in the next years. And to reflect on this trend, if we go to this next slide, I have invited Ravindra from Ecosen. He's one of the companies that has benefited from the trust of donors and investors. So yeah, this is the highlight. So this increased experience by the startup segment is driven to solar irrigation and cooling, and 35 out of the total 78 allocated investments is going to this segment. So Ravindra, thanks so much for contributing to this and sharing about your success. I see you're joined as well, but perhaps you can both introduce yourselves. Thanks.
Yeah, sure. Thank you, Laura. Thank you for calling Ecosen in this forum. So I have joined this call along with my colleague Shantanu Kulkarni, who leads equity and debt investments in the organization. So, however, Ecosen has innovated solutions towards solar irrigation and cooling technologies. And in last 4 to 5 years, we have expanded our operations in this pure segment, especially East Africa and West Africa, by innovating business models as well, leasing and a cold chain as a service model. However, in last 2 years, we have seen many interest and traction towards funding for such applications because of climate take, because of attraction towards climate related activities. So I would invite Shantanu to comment more on investment side and give some more details about it.
Hi everyone. Thanks for this opportunity to share with the fellow companies, because I feel obviously we were also in similar position one time, and the guidance and the experience that everyone get from these interactions is extremely helpful. As you guys are already aware, like we've been through multiple equity rounds. We raised grants historically, and as well as we had a multiple uh, uh, lenders on our balance sheet for our working capital and other needs. This journey has been interesting, and I will just get to the point to explain you our experience and how we feel this journey happens and what should be kept in mind to have the maximum better results. We are in the impact domain, right? So at least in the initial stages, earlier few rounds, the investor that's been approaching you, looking at the impact that you are creating. Okay, so that's a starting point. They understand you are creating an impact. There is a great potential for that impact to carry forward, and they want to be a part of this journey. So they are approaching you. So once you've been approached, you have an initial presentation, initial interaction. So this initial interaction is extremely important from the point of view to explain them the story of your business, what you are doing, how you are doing it, and in very simple manner, so that business is very clear, along with the impact you are achieving. That is also extremely important point, because that's the one of first reason or the important reason that they approached you. And you also should have a clear calculation methodologies and backup of whatever the impact that you are forecasting or that you say you are achieving. So now once you are past that stage, investor would start due diligence. And during this stage, one of the key aspect I would like to highlight is, even though the impact is important reason they approached you, but obviously sustainability of business is also important, right? Because at the end, they are a private capital, they are investor. They also need to have the return at the end, apart from the impact that you are achieving. So along the process of your due diligence, it's extremely important to showcase them that you will achieve impact progressively and increasingly, but your business model is also going to be a sustainable and profitable with a growth in the future. And I think that's the reason that we've been successful in the fundraising, because we are progressively achieving an impact, and not just environmental, social as well. While along the same, we are also doing it at a high growth and with profitability. So that's one of the important aspect I've seen been necessary while the journey of a fundraising to emphasis on to attract the investors. Apart from that, I wouldn't say the other journey would differ much from the other standard investments, where you have to go through diligence, have a data rooms, all the business models and other aspect. I think of which my fellow companies must be much aware of. These are the just couple of aspects I feel are important, and I could add value. I can give as a value addition to overall process.
Thank you so much for sharing your experience, and very interesting. Congrats on your success. It's a difficult period to be raising equity. If we move to the seed investment trends, I also want to hear from other speakers. So actually, if we look at the seed stage, the behavior is quite similar to startup. We do see an increase in equity, and also this year an increase in grant funding. Actually, I think this is the record number of companies in receiving seeds funding in the database. So that's also a reason to celebrate. And then we're going to zoom in as well in the next slide on the equity. So here we'll see the concentration is even larger. It's very good news for productive use of renewable energies. And then perhaps a bit of a cause of concern for households if we're not seeing enough companies that do electrification for households. But let's move to the next highlight, which is really about the success part and about reflecting on this shift of attention from donors, from investors towards pure and smaller companies. And I have Diana from Millennium Engineers to be able to share a little bit more about her experience with financing and how she's doing things differently as well. Diana, over to you.
Thank you. Once again, my name is Diana Bogo from Millennium Engineers. We are a private sector company, mostly based in Pure. So yes, over the couple of years, between the trends of 2019 all the way to 2020, we saw those very little financing going to Pure because it was more of something very new, and investors are now trying to see, okay, how does it work? How are the business models coming out? Is it a business that can go into commercialization? So we were both trying in terms of companies and also investors as well. But starting off from 2021 to date, I think there is high improvement in the pure investment area. And this is mainly due to commercialized or more mature business models that signifies the potentiality for scale up. And this now attracts more investments around that area. Furthermore, I think one of the other issues that is coming up is most governments are now strengthening their electrification systems, and this is now reducing the demand in terms of household electrification. So as governments are now increasing electrification, household electrification in terms of solar is dropping. And what is the next booming need in the industry is now pure. And we can see that from cooling devices to drying devices to simple equipment as in milking, irrigation, grinding. We've seen many innovations over the past, I think, 3 to 4 years coming in that are using solar and are productive use. And this signifies also brings in economic development in these communities or underserved areas. And as governments or a household is bringing in the solar electrification in these areas, they're also bringing in pure to also complement and increase economic or boost that economy as well. I think so far those are the trends I've seen, and I see also we're hoping to see more investment around pure in the next couple of years. And yes, and there will be also innovative or more communal pure investment around the areas, more like community area where they can chill all together, community-based solutions. So that's coming up slowly. I think that's starting off from 2021 as well. And we can see that growing in the next couple of years as well.
Thanks so much, Diana. We really see that reflected in the data. And perhaps a highlight that this year we had observed that the funding towards women-owned companies, women-led and managed companies have raised significantly. It was up 400%. However, it's still far from where we need to be. I think it's only in total cumulatives around 10%. So yeah, good to see one of those. Good to have you here sharing your insights. And in the next slide, we can. So this slide is focusing on the equity raises from startups and seed together. So we saw that the behavior was quite similar, with an increase this year that was an increase in equity, and that increase mainly going to the pure subsegment. And then here, where we want to show is a little bit more of a focus on the household subsector. So we see this year is around half and half. But if we look at previous years, the funding towards household solar startups and seed companies, is not reaching even the levels where it was at 2020 and 2019, 2021. So even if we see a slight increase from a very bad year last year, we still do not see it increasing significantly, which for us keeps on being a bit of a concern. So that's the next highlight. In the next slide, where yes, investments have not recovered. We see a downward trend, and however, we have Tarisai Mureriwa, that is one of the success stories from this year. Natford Energy has been able to raise equity, so very keen to hear from you, even for a company based in Zimbabwe, and we've seen that inflation rates, it must have been a bit of a difficult year, but was still good news. So very keen to hear from you.
Thank you so much, Laura. My name is Tarisai Mureriwa. I'm the finance manager for Natford Energy. Natford Energy is a renewable energy company which distributes solar off-grid products to marginalized communities in Zimbabwe. Currently, we are distributing solar home systems, solar freezers, and recently solar water pumps. And we are targeting households and SMEs. And I'm happy to report that we are among the few companies that have managed to raise equity funding in 2023. I would say to a greater extent, it's difficult for a small business which operates in Zimbabwe and distributes solar home systems on pay-go to raise equity funding. What I've noted in our journey is that most equity funders are interested in the growth opportunities of the company, and they also want demonstration of financial sustainability. Something, believe you, which is very difficult for a small company, especially when you're operating in Zimbabwe. It's very difficult to demonstrate financial sustainability for a company that distributes on pay-go and to households. What I've also noted is that there is also lack of education as far as the financial instrument is concerned. We are not aware on who to approach and also how to approach. Lastly, I've also noted that it is very difficult to value your business as a company, as a small company. It's also difficult and it's very expensive. So you then tend to realize that most of these equity funders would want you to put a price, or rather to have a value on your business, something which is very difficult. I would say that to conclude this, my key takeaways as far as this journey is concerned, the first one is there is need for education for small businesses on what the financial instrument entails. That is education on what has to be done, who to approach, and also how to approach. Lastly, and the most important takeaway that I've learned is for equity partners, you need to find the right partner. You need to make sure that your partner invests more than money, because it's not more about money. That partner should have his or her vision aligned to your vision. That partner should be willing to invest skills so that your vision is attainable and your strategy is implemented. I think that's all I have to say. Thank you, and over to you.
Thank you so much for that contribution, Tarisai. That was a great call to action for everybody as well. Michael.
Yes.
I have invited you as well because I know that you have a very good overview of companies that are actually not able to raise and are not successful at getting that financing. So yeah, perhaps over to you for a reflection on how you see that evolving.
Thank you. Or maybe to rephrase, not yet, but hopefully soon, because at GET.invest, I'm the team leader of GET.invest, and hello, everybody. We essentially do what Tarisai has just outlined. We help companies get ready for and then find, mobilize, and sign eventually the funding that they need. So I want to give a bit of a strategic view on, in particular, that topic of equity as far as we can see, because we're also quite exposed in the donor context in the development community. And we see, of course, a lot of companies and a lot of conversations. So I don't want to repeat what others have said, but build on it. So there were a lot of positive developments as well, but we also see in the pipeline at this moment, I think about 50 companies that we're supporting in this space. And especially considering where we all want to get, that there is a big shortage of matching of suitable capital, in particular equity. Now, on the one hand, it is a difficult geopolitical market environment at the moment. And this is not just affecting our industry, it's also affecting others. But to maybe highlight the main drivers and then also after that go into what could be done about it or what we together can do about it. So of course there are the macro shocks. We didn't ask for COVID, and nor did anybody ask for the Russians to attack Ukraine. There have been supply chain disruptions, interest rates went up, high volatility in currencies, and all this directly or indirectly, of course, affects the ability to pay of people who need to make hard choices in some cases on where to put the scarce money. And that affects, on the one hand, the revenue of companies. And we talked about the productive use, so this affects in particular household solar. By the way, the utilities feel the same thing, and mini grid companies too, so it's not just off-grid solar. So anyways, but then also the capital supply of the companies is affected. So this has contributed to companies being, many companies, not all, but many being in a difficult situation at the moment. But it's not all. If we want to see the full story, we also need to acknowledge that there have been business practices that exacerbated that. We believe that there are cases where quantity over quality in growth was prioritized, which has further contributed to clients not being able to pay, which has affected viability. And that we have had these conversations with equity investors that's shaping the perception of some and their appetite to go into the sector. Investors, and I think the colleagues from Ecozen pointed that out, it's not just impact, also they want to see a path to profitability and they want to see exit perspectives. There is, however, another aspect, and that is that donor priorities have somewhat shifted. Donor money, public money is getting scarcer. And concessional capital, for example, the first loss or equivalent that is at the root of a lot of capital that went into the sector through the different funds, it's becoming scarcer. Now, what can we do about this? And there are two levels that I would like to propose. One, we can convince donors to put up more funding, take more risks, as they should, convince the DFIs. There are notable exceptions present in this call, Jeff, but not everybody is BII. And we need more DFI participation in this to crowd in investment and to enable companies to grow and thereby also unlock more access for customers. But I have more on that to say later in this call. The other thing that we can, of course, do is to encourage companies to do better, to generate results. Here, as the colleagues from Ecozen said, but also the other colleagues on the call here. But we can do better than just encouragement. We can also directly support this. We do that through our core work. But there is also new work coming up. So GOGLA has an important work stream in this regard on the consumer experience. And there's also a new package that is coming up. We're also exchanging with the colleagues of BII on this, who have similar support online. And that is to support companies in improving credit management. And we're teaming up on that with the Paygo Lab. This is about to come online. And yeah, with this, we're positive that we can support companies to do better. Thank you very much for now, Laura. Thank you.
Thank you so much. And thanks again for all the support to our access to finance work. It really helps build our work and our understanding, our access to finance. So we're very aligned with everything that you have said, but we'll get back to that as well. So this is just to put numbers in perspective. So we have received 425 million, but our latest outlook report with GOGLA and the World Bank said that we need 3 billion yearly just to accomplish very basic levels of access, let alone higher tiers. So it's still, we're very far, and we need to multiply our funding times 7 to get just to the very basic goals. And then in the next slide, we have one on subsidies. We have also tracked the subsidies that have been committed to the industry, just to put everything into perspective and the finance flows that are coming in. So there are close to 800 million RBFs committed until 2023. However, 417 were committed in either last year or this year. And knowing that RBFs take quite a while to disperse, we do know that this very big amount of this highlight has not reached companies at all, which to me also means that the industry has been able to achieve great impact even without a lot of subsidies. So something for us to reflect on. Same source, our MTR said that we need 4.5 billion to address the affordability gap. So even with that important number, we're far from goals. In the next slide, we have highlight 6. So yes, we're far from goals, and I know Jeff and Michael work closely with us in thinking how we might increase the funding towards our space. It's certainly not easy, and Michael, you've shared a little bit in your intervention earlier, but just wanted to invite you to share your thinking along these lines. How can we get there? Not an easy question. Michael, you go first. I see you're muted.
Okay, good. Yeah. How do we convince the different actors to put more investment, to put more capital into the sector? So there are 3 levels. One I've already mentioned is the industry itself is of course called on to do your best to be viable, to be attractive for investment, and as I've said, we and others of course can support that. Then the second point, we can see how we can tap more and innovative financing solutions. Geoff, you referred to that. That's one way of doing it. And the GOGLA working groups have been instrumental in this, and want to appreciate the work of GOGLA and of the many people who contributed to this on receivables funding. There's also discussions on carbon finance. Local currency financing is another important topic, and we have a new work stream at GET.invest coming online on this. So the second one is about getting and tapping into new and innovative financing solutions. And the third one is to get the donors back in, or to get philanthropy in. There is also good news. I was last week speaking at the spring meeting of the World Bank. I wasn't in Washington. I was dialed in to a session on the Ascent program. I and many others, we have high hopes on Ascent. It's a big thing for the World Bank. We really appreciate that the World Bank is believing in private sector. It's actually quite a change for the World Bank, as many of us will know. Philanthropy is a topic in itself. Work can be done here. I want to talk a bit about the donor motivation. I speak in other foreign contexts to a lot of donors. We speak to them. And there is a shift in attention and in priorities. What I fundamentally really believe we need to do is re-explain why off-grid solar matters. Yeah, policy priorities have changed. Cut a long story short, people are becoming a bit more selfish. I, however, believe that off-grid solar, including productive use, but also including household solar, has strong narratives to also satisfy, deliver on these new priorities. We have a story to tell on climate change, on mitigation, but I believe perhaps a bit stronger on adaptation. There is a story to be told on trade. There is a story to be told on what you could call the roots of migration, of actually addressing poverty. And we need to tell that story. And we need to tell it better, I believe, and we need to make sure that the right people hear it. 60 Decibels has done some great work, a fantastic publication on why off-grid solar matters. I encourage you all to have a look at this. For the companies, I will encourage you all here to share stories, information, data, including hard numbers of how viable off-grid solar is, also in comparison to other alternatives. Not everybody has understood. And yes, we would like to get grid or grid equivalent everywhere, but that will take a lot of time, a lot of money, and it is not the most appropriate solution for everybody in the short or in the medium term. But we need to substantiate this. And that is work that we're partially doing, but also GOGLA is now looking into. We need to do that. And yeah, Drew shared the report on receivables financing. Excellent, Drew. Thank you. But but not least, and not to take much time, not to have to speak again, I want to really encourage all of you here to keep engaging. Please work with and through GOGLA. Also, please make use of the support that we have to offer at GET.invest. We have more resources to support you, more firepower, but we're not the only one. And so use the available support offers that are out there also of all the other partners that are working in the space. Thank you again, GOGLA, for bringing us together here. And thank you for the great work on the investment data.
Thanks so much, Michael. And Jeff, you can perhaps share your thoughts as well.
So obviously it's a huge challenge. There's a huge financing gap and we're a long way from where we need to be. So we all need to, sort of dig deep to do whatever we can within the context of our own organizations to try to help address this and really treat it as a collective challenge. The way I tend to think about this is the types of capital that are needed to address the challenge. So one clearly is concessional capital, and then I think that's really to address risk and affordability gaps. And then I think there's the more commercial type of capital that needs to come in as well, in the form of equity and debt. I think Michael just laid out very clearly some of the issues around concessional capital. I think there it is really, and I would just underline what Michael said, it's about all of us bringing this dialogue, making sure that energy access remains at the heart of this dialogue. I mean, there have been some really encouraging developments. The World Bank has announced some major new energy access programs with big numbers behind those. And, some of that capital will flow to off-grid solutions. So that's fantastic. And we need to build on that because we have seen a number of foundations and other donors kind of moving away from it, focusing either on climate more generally or within the access space, perhaps prioritizing productive use or higher access tiers as kind of the only solution. And I think it's important, as Michael emphasized, there is an energy ladder, and we need to help people get on that ladder. It may initially be at a low tier and then build from there. And I think it's very clear that off-grid solutions are very cost effective for a huge number of the unelectrified population, which we know is primarily rural Africans. So I think it's really about policy and communication, and obviously GOGLA plays a huge role in that, but I think all of us need to support that. But maybe then to focus on the more commercial end of the spectrum. And I mean, the first thing I was going to say, and this was already picked up very nicely in one of the comments that I saw, is that I don't think debt is really the problem. I think debt is generally much easier to raise. There are DFIs, there are specialist funds that are focused on decentralized solutions. And as long as the other pieces of the puzzle are there, I think that generally comes together. Where we really see the big challenge is equity that comes through in the numbers that we saw this year. And I chaired a working group with a lot of, really experts from around the industry looking at this challenge of equity and how can we make equity more available. So just a couple of highlights from that discussion. I think there are materials that are more detailed that GOGLA has made available, but maybe just a couple of highlights that I would mention. The first is that we need to stop, so to attract equity investment, you have to have a certain level of profitability. And the industry as a whole is still not profitable, and we need to address that. Otherwise, commercial-ish types of equity just won't come into the industry. So how do we address that? We need to stop repeating some of the mistakes that we've made in the past, which I think I would characterize as generally prioritizing scale over unit economics. And we need to reverse that and make sure that companies are really focused on being profitable with each of their sales and then scaling on the back of that and not the reverse. The second is really focusing on credit quality. We just can't build this industry with very poor performing receivables books. Michael mentioned the work that they're supporting around that. So I just think this is a huge opportunity to address that, to get better at that. And it's not just about company profitability, it is also about customer experience and consumer protections. So it's really an issue that cuts across all of the industry stakeholders, and that's one that we're really trying to push for. And then as a structuring solution, we talked about off balance sheet, but I think one thing that we can really do to try to unlock more commercial capital is using blended finance structure. So that was something that everyone in our working group really strongly endorsed. So we can layer these different types of capital. The more risk tolerant types of capital can sit at the bottom of a structure to provide risk enhancement that would allow us to more easily mobilize more commercial types of capital and hopefully have a really strong mobilization effect. So those are a few of my thoughts on how we might try to start addressing this.
Thank you so much, Jeff. That was a fantastic summary of what we discussed in the equity and a great call to action for everybody. Yeah, perhaps in the next slide, if we can move, we can move to questions. So I saw there are a few questions around off balance sheets structure. So I see from JB Lenoir, why do you think this will really increase the availability of debt for us? Are there new investors coming in because of the structuring only? I think Jeff partly addressed that in terms of the new investors coming in. We have seen that some national finance institutions can step in if they see they're sort of like risk isolated without having to invest in the company directly, but in the special purpose vehicle directly. But perhaps, Jeff, I want to hear your thoughts on that one. Yeah.
So on the first one, yeah, I think the second point around debt being relatively easy, I agree, and just spoke about that. I don't think off balance sheet necessarily increases the availability of debt overall, but it's a different type of debt. And speaking to the issue about equity, I think it is a solution that can allow companies to lower their equity requirement. When you're holding those receivables on balance sheet, it's going to be financed with a mix of debt and equity at some ratio. But typically there will be a significant portion of the company's equity that has to finance those receivables. Whereas when they're being sold off balance sheet, typically that equity requirement is much smaller and can take the form of discounts on the receivables. So it can be a more equity light solution, I think, and so indirectly help address part of that challenge. And then there was another question on the demand for off-balance sheet financing, and does this, sort of make a difference to investors? I think the structuring can make a difference. I mean, at the end of the day, it is about the strength of the overall company profile. And so I think that's why you've seen, market leaders being able to raise this type of funding. But some banks will have requirements around say, for example, having 3 years of income positive financial returns before they can lend directly to an entity, whereas this off-balance sheet structure can sometimes get around those constraints. And I've lost the other question now. I think it went to the answered section. Yeah, just sort of around the appetite and the macro risks. So macro risks are very real, and I think around currency fluctuations, for example, when you get local banks that have local currency balance sheets, they're matched. So that makes it much easier to manage that macro risk. That doesn't eliminate some of the other challenges, but usually there is some flexibility built into these structures so that it can adapt to different levels of sales. It can adapt if you see, for example, portfolio quality deteriorates or improves. There can be some dynamic structuring aspects to that to try to address some of those macro challenges that might feed through into the results of the company.
Thank you so much, Jeff, for that answer. And perhaps I want to give it very quickly to Diana, because I know she had an opinion around the accessibility of balance sheet structures towards smaller companies. And there was a question around the demand from companies. So just want to give it to you quickly to reflect on that.
Oh, yeah. So one thing I do note is as much as it may be expensive at the moment for smaller companies to actually access off-balance sheet financing, but I think it's quite important to now sit down and look at what is the need assessment, and then structure really good innovative financing schemes that can get to smaller businesses. Because for example, for my case, I have experienced needing that off-balance sheet financing, because you find that one investor does not allow you to have a loan while accessing a new financing round, while at the same time, I need an X amount of money to be able to complete a certain milestone for reimbursement, results-based financing. So that gives us a really big delay in terms of working on our own to try and find how can I access an X amount of financing? How can I access X amount of financing so that I can move? It's more like bridge financing. And I think it will, as much as it might be expensive, but I do believe there are ways, as much as we've been able to get through from financing large companies to now financing smaller ones, it can be structured in a way that it is easier for us to access, or as part of an investment, when we're doing seed investments, we can structure an X amount of financing as off-balance sheet financing that is accessible to those smaller companies on a need assessment basis. And we already start with those conversations from day one. And I think other than pushing it off, then we will see a very slower growth of those seed companies or smaller companies moving into the startup phase and moving into the large scale. So we need to react now, other than saying later on. Yeah.
Thanks so much. And I know there are more questions, but we're almost at time. This is a really packed webinar in terms of data sharing as well. So I just want to give it very quickly to Ravindra and Tarisai as well for your 1 minute sort of like call to action or conclusion. And then I'll move on to present a few more things that we have. Tarisai, perhaps you can go first.
Okay, thank you so much. As mentioned by my fellow colleague, the industry is not yet profitable. And for us to realize our impact, we need for us to continue subsidizing the industry. Lastly, I also call upon all the stakeholders to continue investing their time in educating small businesses as far as various financial instruments are concerned. Let's continue supporting the small businesses. Let's help them build the metrics that they desire. And also, let's connect them to the right people, especially investors. Thank you. And over to you.
Thanks so much, Tarisai. Perhaps Ravindra, can you share your sort of like 1 minute key takeaway and then what you want others to hear from you? Okay, I'm going to actually then give it to Michael, actually, and
Yes.
perhaps if you can, like in that 1 minute, respond to that question that you have on the
Thank you.
equity expectations and reality, that would be great.
Yes, because I want to answer Audrey's question. That is a fantastic question with a lot of keywords in there. One would think that for companies with a solid business model and a pathway to profitability, it is not that much of a challenge. Unfortunately, it is. And one of the reasons is, and we have done a mapping, we have a finance database of finance instruments, and we try to keep it up to date. We can see where the problem is. The problem is between 1 million and 10 million. There's almost very few actors still providing equity in that space. And the problem is also that some of the ones that were strongly engaged in the sector either have not globally, like they have country-specific funding now, or they are moving out of equity for various reasons of their own. And it is actually, to boil it down, ticket size expectations are too big, return expectations are too high, and yes, also investor knowledge often is too limited. In order to handle equity, one really needs to understand the companies, one really needs to understand the markets, and not everybody does that, has that, or can afford that. And these are the things that would need to change. So voila, and that is where, inshallah, donor capital, concessional capital comes in, but we need to work towards that, as I outlined before. Thanks.
Thank you so much, and hopefully, Joey, that partly answers your question, but we can connect separately as well on these topics. And yeah, I would like to actually move to the next slide. So yeah, a few of the speakers have said it already, but what we observe as GOGLA is that we need blended finance for the industry. You've seen the numbers, we are very far. And blended finance is imperative. To me, it feels a little bit, we have companies that are actually serving public goals, and those have generally not been financed through private capital only. So I don't think it's an unfair request from the industry, and there's too much on the shoulders of the private sector to be delivering that much impact with just private capital. And in the next slide, we have a slide that exemplifies what we are building as the financial vision for the sector. So if we click through, we will see maybe we can click through all of it already. So we have, together with investors, companies, different stakeholders, identified 5 different levers for the industry. So improving consumer experience, like we have mentioned, that includes improving credit risk management and consumer protection, more and better subsidies for the industry, receivables financing, and more concessional capital. And the one missing, not sure why, is local currency financing and the risking instruments, because it's also, there we go. it's also not fair that, we're facing big macroeconomic issues and the cost of financing is so high that we do not have instruments to weather those storms. And yeah, we see that portfolio quality leading to increased profitability leading to higher investments from equity stakeholders, among others, and that's all leading to impact. So I invite you to please work with GOGLA, work with us, and engage, in the different options that we have, become a GOGLA member. But I have a couple of slides coming up to just present alternatives for gathering. So we have our AGM in June 18th and 19th. This is for members, and we invite everybody to join, to hear from the World Bank, for instance, and to engage with all members, network, and work together with GOGLA. And then in the next slide, we have the exciting Global Off-Grid Solar Forum happening in October. And then in the next slide, I have it's the co-hosts are the World Bank and the government of Kenya, and this year we're expanding in terms of themes. So content partnering with AMDA, the GDC, and the Africa E-Mobility Alliance. We expect more than 1,500 attendees, 90 exhibitors, and more than 100 policymakers. So it is the moment to get together and to solve the big challenge that we have at hand. And I think there's a last slide that goes to cover the different themes, technologies, and tracks that we're envisioning for the Global Forum. So with this, I think, in the last slide, you can see my email. There are a few questions that we have not been able to respond to. So please feel free to email me and, let me know whatever doubts you still might have around investment data, around the financial vision for the sector, or anything. I want to thank my speakers, Jeff, Michael, Tarisai, Ravindra. It's been great to have you. I really enjoyed the webinar, and thanks for working with us. And thanks to all the attendees for spending a little bit of time with us. And see you very soon.